Hello everyone and welcome to this mid-year market update. We're going to take a look at the current investment landscape and what it means for you. As we enter the second half of 2025, it's a good time to pause and reflect on the market's performance so far. We'll be examining key trends and shifts that have shaped the financial environment this year. So let's take a quick look at where the markets stand, focusing on the major indices and sectors. We'll provide a concise overview of the current situation. Investors have been cautious, carefully evaluating market conditions and potential risks. This cautious sentiment is influencing investment decisions across the board. They are holding fewer shares in more volatile sectors and favoring safer assets like bonds and dividend-paying stocks. This shift reflects a desire for capital preservation. Gold has surged as a safe haven, with investors flocking to precious metals amid economic uncertainty and geopolitical tensions. Meanwhile, bonds and high-interest savings accounts continue to offer attractive yields and remain popular for their stability, providing a sense of security in an otherwise turbulent market. With inflation stabilizing and showing signs of easing, cash is finally earning real returns, offering investors a viable alternative to riskier investments. The mood is one of prudence. A measured and thoughtful approach to investing is prevailing. People are prioritizing protecting what they've built, focusing on wealth preservation rather than chasing risky gains. It's a wait-and-see approach as investors carefully monitor market developments and economic indicators. Portfolios are being built for resilience, designed to weather potential storms rather than generate explosive growth. After years of significant volatility and market fluctuations, steady financial planning with a focus on long-term goals is the top priority for many. While caution is paramount, there are still opportunities to be found in the market, but investment decisions are more deliberate than ever, requiring careful analysis and due diligence. In short, caution rules guiding investment strategies and shaping market sentiment. But even with this cautious approach, optimism hasn't disappeared entirely, as investors remain hopeful for a brighter financial future. On the surface, markets look calm, almost deceptively so. There's a sense of tranquility that might lead you to believe everything is stable and predictable. But beneath this veneer of serenity, a more complex picture is emerging. US stock indices are up, painting a rosy picture of economic health and investor confidence. The upward trajectory suggests a thriving market, attracting attention and further investment. But this growth is driven by a handful of giant companies, the mega-cap stocks that dominate headlines and market capitalization. Their performance heavily influences the overall indices, not the whole market. Many smaller companies and sectors are not experiencing the same level of prosperity, indicating a potential weakness in the broader economic landscape. The US dollar has weakened, impacting international trade and investment flows. A weaker dollar can have both positive and negative consequences for the US economy, making American assets cheaper for European investors, creating an incentive for them to invest in US markets, and potentially driving up asset prices and boosting returns when converting back. This currency advantage further enhances the appeal of American investments for those holding foreign currencies. Gold's strength signals underlying caution, a traditional safe haven asset that investors flock to during times of uncertainty or economic instability, even as inflation stabilizes. Despite the apparent control over rising prices, the continued demand for gold suggests that some investors remain wary of future economic shocks. So, while things seem steady, with key indicators suggesting a period of relative calm and predictability, there's tension beneath, a subtle undercurrent of unease that warrants closer examination. A few winners dominating the market's gains, a weaker dollar influencing international trade dynamics, and investors hedging their bets, preparing for potential market downturns. The market is balanced, precariously poised between growth and potential instability, but it wouldn't take much to shake that calm. A single unexpected event could trigger a cascade of reactions. It's a tightrope walk, a delicate balancing act between optimism and risk aversion, steady for now, enjoying a moment of relative tranquility but always at risk of a wobble. Vigilance and preparedness are key in navigating these uncertain times. The big question, will central banks cut interest rates soon? Markets expect rate cuts, hoping for cheaper borrowing and economic growth, but new tariffs or rising inflation could delay or even reverse those cuts. Political uncertainty, with major elections ahead, adds to the unpredictability. Central banks are cautious, waiting for clear data before acting. Rate cuts are likely, but not guaranteed. Delays are possible. Investors need to watch central bank moves closely, but know that outside events may tie their hands. Flexibility and vigilance are key in this uncertain environment. In the dynamic world of investment, not all sectors are created equal, especially right now, as we move into the second half of 2025. Some sectors are poised for growth, while others face headwinds. Tech remains the favourite, continuing its reign as a leading sector. This is largely driven by AI and digital services, which are attracting significant investment and fueling innovation across various industries. The digital transformation is in full swing, and tech companies are at the forefront. Banks are also in favour, showing resilience and strength in the current economic climate. This is thanks to healthy profit margins boosted by the recent higher interest rates set by the Federal Reserve. These rates have allowed banks to increase their earnings and maintain profitability. Energy, especially oil and gas, is facing a different reality. It is currently out of favour with many investors due to the growing emphasis on green energy trends and sustainable practices. Adding to the challenge is the inherent price volatility in the oil and gas markets, making it a riskier investment for some. Consumer staples, think food and household goods, are often viewed as reliable but not particularly exciting. They are seen as safe but unexciting investments offering stability rather than high growth potential. As a result, they're often being overlooked in favour of more dynamic sectors. Investors are primarily chasing growth opportunities in the tech sector, seeking high returns and innovative companies. Alternatively, they are seeking safety and stability in cash and bonds, which are considered safe haven assets during times of uncertainty. The middle ground, with its moderate risk and balanced approach, is currently getting less attention from investors. The key focus is on either future potential with high growth stocks or current stability with defensive assets. Ultimately, picking winners in this environment means understanding these shifting preferences and aligning your investment strategy accordingly. Market is balanced, but risks loom. A tariff war could disrupt trade and hit profits hard. US government debt is a growing concern, threatening global confidence. Geopolitical tensions and the risk of recession can't be ignored. Volatility could return quickly, so caution is wise. Don't make rash moves or bet everything on one outcome. Use this information as a guide, but tailor your plan to your own goals and risk tolerance. Consider speaking to a professional advisor to help you navigate the uncertainty.